All right, Doug, I think I'm going to enter this in the portfolio as well. Doug's got a question, I think, on another married put position here. Wait, let me read it first better. So, bought HD March 25th, 295.23. Home Depot, HD 295.23, 325. Bought July 340 put May 7th. Sold the 315 put. Okay, so you did a spread on top of your stock position. Oh, I'm sorry, July 340, July 315. Did a Bear Put Debit, huh? For 14.12, and the 315 put was 9.85. Okay. All right, so I'm just going to build this on the fly rather than do it that way. We're just going to use the custom spread tool. So I wanted. It's not a married put question directly. I thought it was, but it's a little bit different. So HD, Doug originally bought. We'll just keep it at 100 shares. We bought it at 295.23. Now he's asking, of course, should I close my spread or roll it down now after earnings? Okay, so let's look at July. We're at 315. You said you sold the 315 and you bought the 340. And this was 985. So this is a Bear Put Debit spread on top of a standard stock position, a type of protection for an earnings play in case the stock really fell, I'm assuming, or if it, we'll take a look at the stock chart in a moment. July 340 at 14.12, okay. Okay, so there's sort of that glyph of the Bear Put Debit spread there between 340 and 315. Oh yeah, your break. I'm sorry, I'm looking at your break even. Your break even's not to 274.50 in this case. All right, so you've got a 25-point spread. 25-point spread, and I'm just looking at the numbers here. I'm sorry, you've got a debit of $4.27, right? Yeah, $4.27. So debit of $4.27 on the 25-point spread. Why is that important? I'm going to see here what the values are to close. Let's go back to July. Now it's not. This is not fully in the money, but let's give you a price here about 27.40 midpoint ish, Doug, and let's just call that 10.90. So closing this Bear Put spread now, the Bear Put Debit spread, you paid about $4.27 to get into the position. If you liquidate now, you're getting about $16.50 back. And of course, the most you could get back for it is 25 if the stock is below 315. Okay, so that's, yeah, you were taking in about 16 now, 16.50 to close it. Oh, sorry, so that'd be a profit of 12 on that hedge that you did for the earnings, which still left the downside open. But if you leave it open and it keeps staying around this area, going down to 315, you're going to start seeing the two time values decay out, and you'll get closer to $25 as you get closer to that July expiration, which is 56 days away. A lot could happen between now and then, I understand. So I'm just showing you here, in this case, that just showing you where you are now. I can't tell you what you should do with this position. Should you close your spread or roll it down? And I can't give you direct advice here. If you close it, you're getting $16.50 back. If you leave it open and the stock continues down a little bit and it continues to fall below 315, you'll start getting closer and closer, Doug, to that maximum profit on the spread of 25. But what's also happening? You're also losing on the stock position. The stock's losing at a delta of 1. These two are hedging against each other in this case, where you're getting some dime decay in your favor for that Bear Put Debit spread that's working in your towards that 25. I'm sorry, working towards that $25 difference in strike prices that you might be able to get back in that case. Yes, everything here just broke with that earnings, broke below the 20-day moving average. It hasn't had a lower Bollinger Band breakout. It tried to recover a little bit and move down in price. It was up near 320, but it came back down to 315 area, Doug, in this case. I don't know if I would roll it, but that's up to you. I don't know if rolling down would put you in a better position. The temptation is to wait to see if the stock continues down and you get more back of that expected $25, understanding the risk that as it falls now, this isn't, I mean, this is a slight hedge on the position, but it's not really a great hedge. It stopped the loss that would have gone on just the straight stock position from here to here, right? This would have been it without the spread. So you gave yourself a cushion of protection with this debit spread. But notice the halfway mark, the curved red line. Okay, so the curved red line is hard to see, but that's pretty much almost a straight line right now at the halfway point at 621. Next month, June 21st, a month away before that expiration. Not as steep as what the stock loss would have been without this, of course. As I mentioned, if you had just bought the stock at your price, the decline you'd see would just straight be this. And that's terrible at the end there because it would have gone like this. Okay, but that's kind of what you'd expect, is that straight line going down in that direction. You gave yourself a mini hedge here, but now you can still start to lose. So the question is, what are you most comfortable with? Buying back the short put is going to cost you money. You sold it at 985. Is that what you said? Yeah, I'm sorry. You sold it at 985, and we saw it's about $11 to buy back now. But you've also gained much more on the long position that you originally paid $14.12 for, and I thought it was now up at 17. Is that correct? 18 in that realm. So that's got you the most. Oh, I'm sorry, it's 28. That's got you the most profit of this position. But again, it's costing you $2 more. So not really, $1.12, $1.15 more to buy to close that position, Doug. So just buying to close this and leaving this put open is going to add to your cost basis on the position. As we saw here, the risk of waiting, if you feel the stock's going to continue down, and to try to get more of that intrinsic as the time value starts to decay out. The problem here is that you want to see a rapid decay on your 315 put that you sold in that Bear Put Debit Spread, but it's not going to decay anytime soon. It's going to be the last 30, 15, 20 days to expiration when that really starts to decay, assuming the stock is still below. What did we talk about earlier with the at-the-money bell curve? You sold the 315 put. So in July, put in the call with the highest time value, which you have to buy back right now to cancel your obligation, is the 315 strike. So what are the options here? Do nothing. Wait to see if you get more time decay and get closer to that intrinsic value of 25, 20 points to close your 340, 315 spread. If your concern is the stock could continue to fall, remember you're going to be losing more dollar for dollar on the stock course, delta of 1, then you're going to be getting back from the decay of these two positions because it's limited. It's a spread. It's got a capped downside hedge for you. Okay. So that's the risk. As you can see, if it continues down, you're starting to give up more on the position. In this case, of course, but you're still profitable. Don't get me wrong. I mean, it has to drop down to 274.50 before you start losing money on the position. I'm just showing you where your profit looks now versus where it kind of is if you leave it open. You could liquidate it now and take that $16 back on the position if you wanted to. Just liquidate and close the spread portion of the position and leave the stock open if you think it's going to recover. But also, if you think it's going to recover, there's not much risk here letting it go up. But again, you're going to be losing here. So the Bear Put Debit we're looking at here with the 315, 340 in this case. That's the 315 and the 340. What it did added to the stock naturally is it caused a brace in this section. So that normally, as we saw, the stock would have continued down if he just owned the stock and it was trading up here and then it just started to fall. Gives himself a table profit window from 340 to 315. But it doesn't Now, it did hedge, of course, so that if the stock was trading here, you might actually be at a loss without the Bear Put Debit Spread in. That's perfect, Doug. I see that, and that's why I said it's not a full hedge, but it's a reasonable hedge for this window. But now you're at the point where you still got 60 days to go, so you're not at max profit of that debit spread position because both of these options still have a lot of time value, and the one that you sold that you have to buy back again at the money bell curve is at the highest time value right now at 315. The stock starts to move back up a little bit. You might be in a range here. The 315 is here and the 340 is here roughly. You might see a good price to close it even if it moves back up again between 315 and 340. But you have to ask yourself for this position by itself, not the spread and the hedge, but the stock itself. What are your goals for the position? What are your expectations now that you've known what happened with the earnings? We've seen the downward trend in the last 10 days. If you think it's going to continue down, maybe it might be best just liquidate this whole position and take the profit, or do nothing. If you think it's going to stay in this range between maybe, let's say 300 to 325, you get more time decay out of that option that you sold, or look for a time when you're not paying back into the highest time value right now to do an adjustment or even close your 315 put. Okay, but again, that would be determined by your expectations, Doug, your goals for the position, and what your future outlook is on Home Depot as well in this case. So we could do nothing and wait for some of that time value to decay in our favor, or until the 315 is not at the highest time value, we'd have to buy it back. Do nothing and wait. You could liquidate the whole position right now, exit the trade, and take the profit that you have on the position. Looks like about, you're probably close to about 3,800 here, maybe 3,600 here, somewhere in that range, to just close it now, Doug, in that scenario. Would I try moving the spread any which way? No, I honestly wouldn't, because this one, I definitely wouldn't move that leg, because again, it's right at the money. It has the highest time value, and that's the option that you sold. So any kind of rolling or adjusting now means you're paying back into the highest time value at this time. I'd look for a different opportunity when I'm not buying back the at the money option with the highest time value at this moment. This one's in the money, so it has a lower time value, but it has a good intrinsic, and that's where we talked about liquidate. Is it worth it to close just the spread now and leave the stock open? Well, again, just looking at that stock chart we just saw after the earnings, you'd have to ask yourself, are you comfortable with just the stock position in place without this table hedge, where now that you buy it back, your decline might be more along the lines of this, since you've gotten some of the profit back and lowered the cost basis again on the position for that 16 or so dollars you'll get liquidating the bear put spread. Okay, but yeah, rolling that short option now is what's tricky to me, because it has the highest time value in that case. And so I want to wait. Yeah, all about the time value at this point, especially with 56 days to go. That's the rough spot with some of these farther term debit spreads, which are just straight debit spread plays, Doug, or hedges for a stock position, or hedges for a short stock position. When it's still 45, 50, 60 days out, you say, hey, it's below my short put strike price. Shouldn't I be at max profit? No, you're not going to see that till you get closer to expiration. Time values decay out a little bit more. You're getting closer to intrinsic value as you're within the last 10, 15, 5 days to expiration in that case as well. Today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stock or options discussed today should not be taken as direct recommendations or direct trading suggestions. I didn't give Doug direct advice on what I think he should do. I kind of did, where I said, well, you got 56 days to go. If your expectation is, might want to just wait on the position. But we want to show ideas. We want to show opportunities, and that's what we share today. Options do involve risk and may not be suitable for all investors.